In this video, I'll show you how to trade pullbacks. Trading pullbacks is simple, easy, and can be very profitable for you. To trade pullbacks properly, you need to master 3 important trading concepts. First concept is support and resistance, and then understanding market conditions and identifying candlestick patterns. So, what is support and resistance? Look at this chart. You can see here that the price moves up and then reverses, forming a level of resistance. When the market goes up again, it hits this key resistance and reverses. Resistance is the level at which supply is strong enough to stop the market from moving higher. Every time the price reaches the resistance level, it struggles to move higher. Now consider another chart example. The price moves down before drastically reversing and forming a key support level. This level becomes a psychological point in the market. When prices drop again, they hit this level and reverse, offering a great buy opportunity. Support is the level at which demand is strong enough to prevent the stock from falling further. Each time the price reaches the support level, it finds it challenging to break below that point. Let's move on. Market conditions. Market conditions encompass 3 main scenarios you will encounter while trading. Uptrending market conditions. This occurs when the market consistently creates higher highs and higher lows. Buyers dominate this market. Downtrending market conditions. This type of market forms lower highs and lower lows. Sellers are in control, and the optimal trading decisions should revolve around selling, following the market's direction. Ranging market conditions. This market moves sideways, oscillating between significant support and resistance levels. In this situation, buyers and sellers are evenly matched, and the best trading decisions should be made from these boundaries, either from support or resistance levels. Let's move on. Japanese candlesticks. Japanese candlesticks are a type of price chart displaying the opening, closing, high and low price points for each given period. In our pullback trading strategies, you'll use Japanese candlesticks as signals. These signals include the pin bar, the engulfing bar, the doji, and more. Now that you understand support and resistance, market conditions, and Japanese candlesticks, these concepts are crucial for you to grasp if you aim to trade pullbacks profitably. A pullback, often called a retracement, occurs when the market reverses momentarily as traders take their profits. Let me illustrate this with an example. The market is trending upward. As traders begin to cash in their profits, the market starts moving downward, creating a pullback. In essence, there are 2 significant movements in the market: an impulsive move following the trend's direction and a pullback move against the trend. To profit in the market, you need to learn how to recognize the end of a pullback and the start of a new impulsive move. That's precisely what I'm here to teach you right now. The first step you need to take to trade pullbacks is identifying the trend. Look at this chart example. You can see a clear uptrend here. The second step is pinpointing support or resistance key levels. In this chart, there's a distinct resistance level that turns into support after the breakout. Our strategy revolves around waiting for the market to break out of this resistance level, which then turns into support and subsequently experiences a pullback. When the price reaches this level, it's crucial to determine if it's a pullback or a breakout. This is where the third component of our strategy comes into play. As you observe here, when the price reached this level, a remarkable pin bar candlestick pattern emerged, rejected from this level. This specific Japanese candlestick pattern serves as our entry signal. It signifies the end of this pullback and the start of a new upward move. To execute this trade, you place your entry at the close of the pin bar. Set a stop loss 20 pips below the pin bar's wick to safeguard against being prematurely stopped out. Your target is consistently set as the next resistance level. Now, look at what happened next. The market moved precisely in the targeted direction. Let me give you another example. Here, we're looking at a clear upward trend in the market. During such trends, there are typically 2 main moves. First, a strong move in the direction of the trend, followed by a pullback or a brief reversal. To take advantage of the end of the pullback and catch the beginning of a new upward move, we need to spot a crucial support level. In this case, a previous point of resistance has now turned into a support level. When the market retraces and tests this level again, our plan involves waiting for a specific signal from a Japanese candlestick. In this instance, we see a significant pin bar signal, indicating the end of the pullback and the start of a fresh upward move. This candlestick pattern is our signal to enter the market and benefit from this new upward movement. Okay, now observe what happens next. As expected, the market moves in the direction we anticipated, validating the effectiveness of this approach in identifying favorable trading opportunities. In this example, the market is going down, and we've spotted a key level that used to support prices, but now works as resistance after the breakout. When the price nears this level, we prepare for a potential new strong move. Next, we see the market pull back and form a bearish engulfing candlestick pattern. This pattern suggests the end of the pullback and a possible new downward movement. A tip for trading pullbacks: look at three things: the trend direction, important levels, and price action signals. Now, let's talk about trading pullbacks during a sideways market. The market isn't going up or down. It's moving sideways, which means it's stuck in a range. How do you handle pullbacks in this situation? Here's an easy approach. Spot important levels where the price stops and turns, then wait for a pullback after the price breaks out of that range. See this chart. The market was stuck in a range. When it broke out of a level that previously held it back, it pulled back. So when the market comes back to that level, keep an eye out for a sign in the price movement. In this case, there's a candlestick pattern called a pin bar. It's a good signal to enter the market and follow its downward movement. A quick tip for trading in a sideways market: avoid trading within the range. Instead, focus on trading from important levels or wait for a clear breakout. Don't trade inside that range. In our strategy, rather than trading the breakout, it might be better to wait for a pullback. It could give us another chance to jump into the move. Let's look at another example. A market that was moving sideways for a while. Then it breaks above a resistance level, turning it into a support level. This shift tells us the range-bound market is over. We wait for the market to come back down to this new support level. That's when we expect a strong signal. And there it is. Once the market retraces, we see a significant doji candlestick signal. This signal shows us the end of the retracement and the start of a new upward movement. Thank you for watching. If you enjoyed this video and want to see more content like this, don't forget to hit the like button and subscribe to our channel for regular updates. Your support means the world to us. See you in the next video.